The bulk of earnings season is now behind us. Here's what it means for the market on the Weekend Update. Okay, friends, let's talk about the market, earnings, and where we're at right now. We're actually going to do things a little different this week. We're going to look at the earnings picture first, and then we're going to look at the market. And I thought this graphic from CNBC is pretty great. It kind of tells you everything you need to know about what's happening in the economy right now. This was Apple's most recent Q2 2024 revenues, and what you notice is even mighty Apple is dealing with a consumer slowdown. iPhone, their largest category, sales are down 10.5% year over year. Mac, a small category, $7.5 billion, up maybe 3.5%. But remember, inflation is running at roughly around 3%, so that's sort of flattish data there. iPad down 16% year over year, wearables down 10% year over year, and then services, a bright spot, up 14%. But what this tells us, when I look at Apple's earnings, remember, I was looking at their top line, their sales, as an indication of what's happening to the consumer, and I think Apple is telling us a pretty clear story here. What we have is we have a weakening or slowing down consumer. This is consistent with all the other signals that we're getting with the economy, but all of these brands here, and think about all the different aspects of the economy, are now signaling, hey, there's some weakness going on. We can look at McDonald's and Starbucks, who we heard from earlier this week. They're different ends of the consumer spectrum. Starbucks high end, McDonald's low end. Both of them said, hey, our consumers are getting pressured here. You can look at retail. You got CVS, which is sort of like, must-have sort of things. You've got Costco, which is maybe your more weekly shop for an affluent suburban consumer. CVS is a little bit more urban drugstore sort of retail. Both of them indicated pressures on the consumer. You can move to devices, gadgets, technology, which we all love. We've got Apple results, which were uninspiring to say the least. Of course, they've got a big buyback, so that's why the stock is up. But the business performance was pretty weak. We also saw that from Tesla, which kind of bleeds into autos and EVs a bit. Even apparel brands, Nike, Lululemon, etc. There is just broad-based weakness. And this is one of the reasons why in the previous video I said, I am diagnosing this economy as an economy that needs stimulation. We need interest rates to start coming down. We need to start stimulating consumer demand because we can see it in the results of these companies now. And one of the challenges is going to be balancing that need for stimulation in the economy with the current, pretty high inflation that we have right now, this second inflation wave that we've been talking about. Really tough. Jay Powell just recently came out and said, hey, the picture's a little muddled here. I don't know if we're going to be able to deliver cuts as soon as we need to. So this is definitely a dangerous brew that is building inside the market. Remember, we had all sorts of high expectations going into this year if you look at how the market was priced. Inflation was going to be under control. That didn't hold. We were going to get 6 rate cuts. That's pretty much off the table conclusively now. We'll be lucky if we get 1 or 2. And then, of course, the consumer was to remain strong, and the economy was going to be strong all the way through. This is just, this is basically the first quarter of this year. These companies are reporting, so this is very early days for how 2024 is going to go, and we can already start to see the weakness. So with that, let's look at the market. Red line here is the S&P 500, same way we've always been looking at it. Purple line that you see here is the 200-day moving average. And what you notice is we're still up in rarefied air. One of the things that I talked about was I thought we were going to go into, our first largest correction of this rally since September and October of last year. That has certainly come to fruition. Here's what I think is going on with the market right now. This orange line that you see here, that's the 50-day moving average. And we're not going to talk about where we are right now first. Let's look at September, October, and November of last year. If you remember, this was the last correction that we had experienced, and it was basically 3 months where the market pretty much went straight down. One of the important signals early on in that correction, though, was the market coming down to its 50-day moving average, trying to hold on to it with its fingertips, and then eventually, this was about maybe a month it spent trading around the 50-day, and then eventually it would release, and the next stop down below is the 200-day moving average, where we got our positive test, which continued the rally. If I were to look at where we are today and sort of diagnose what's going on, Well, you'll notice we came right down to the 50-day. We're trying to hold on to it with our fingertips, but there's a lot that's going on in the market right now, both from inflation, rates, and consumer demand. This is going to be a pretty tough test. I will be pleasantly surprised, but surprised if the market continues to hold on to its 50-day and make forward progress from here. What I'm expecting is we're going to go through this testing phase on the 50-day. Maybe it'll last a month, month and a half, 2 months, something like that in duration. And then what I expect is for the market to actually release, and we'll end up with a test of the 200-day moving average. The 200-day is somewhere around 470 right now, which would take us back to flat for the year, back where the market was in December. And I think that is par for the course for an election year, which we talked about previously. Very normal for the market to go through corrective phases like this. Typically, you get a 10% correction in the market just about every year. So that would be pretty close to that. So all of this is normal action. So I think the roller coaster ride of the election year is starting. I think it was a little bit delayed because the early part of the year was so strong, but we're starting to see the signals from the economy that, hey, there might be something going on here. So at least for right now, market looks good. And remember, 200-day moving average tests happen all the time. They're very normal during bull markets or bull phases. So it's not really giving us a signal that, hey, things are good, bad, or indifferent yet. This is just normal market action. So sometimes it's good. Sometimes we're in a testing phase. Sometimes it's bad. But for right now, I think we're in a testing phase on the 50-day. I'd be surprised if we hold on to it. Pleasantly surprised, but surprised nonetheless. So there you go. That's where we are in the market. Normal activity. It's okay. Corrective digestive phases are good for us in the long run. So I'll see you next week for the news review. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.